Welcome to Clever Money Hacks, the channel where money moves and life improves. In today's deep dive, we're tackling a really provocative thesis about the future of finance.
And it's one that argues the next major financial collapse won't look anything like 2008.
Exactly. For the last, few years, the whole narrative has been set on a rerun of that crash, right? A deflationary credit implosion where assets get crushed and cash is king.
Right, but the source material we've been digging into for this just flips that whole script on its head.
It really does. So while the media, and maybe a lot of us, are bracing for another housing crisis or a big stock wipeout, this analysis says we're, fighting the wrong war.
The central claim, and this is the really concerning part, is that the real bubble isn't where we're all looking. It's not in those volatile assets.
It's in the one thing everyone assumes is safe.
Yes. The U.S. Treasury bond market and the U.S. dollar itself. The idea is that they are the bubble, hiding in plain sight.
And the consequences of that are, they're huge. It means your savings, your retirement, the cash in your pocket. As the source puts it, it's all on the firing line. Okay, so let's unpack this. Our mission today is to really get our heads around this reverse market crash idea.
We need to look at why it's so different from 2008, what data is backing this up, and, where this supposed bubble is actually located.
And most importantly, what the proposed strategies are for protection and maybe even growth. So let's start with the big mistake a lot of investors might be making right now.
To really get why clinging to that 2008 playbook is so dangerous, you have to understand the fundamental difference between that crash and the one that might be brewing now.
2008 was a deflationary event, right?
That's the key. It was a deflationary event driven by a massive credit bubble that just popped.
Mostly in the housing market and all those complex financial derivatives.
Exactly. And the result was what you'd expect from deflation. The value of assets, when priced in dollars, just collapsed.
The numbers were brutal. Stocks down over 50%. Home prices collapsed, 30 to 50% in some places?
Yeah, banks failing, unemployment spiking. But there was a critical feature for anyone who was prepared.
The reset button.
The reset button. If you were smart or lucky enough to be holding cash, your dollars actually became more powerful.
You could wait out the storm and then step in and buy stocks and real estate when they were basically on a fire sale.
Precisely. Painful as they are, deflationary crashes always offer that opportunity for people holding cash.
And that is the trap today, according to this thesis.
It's the core of it. So many people, maybe even you listening, are stuck fighting the last war. You're holding on to cash, waiting for things like the inverted yield curve or recession chatter to finally trigger that same reset.
You're waiting for asset prices to fall to meet you.
But this analysis says that's a catastrophically flawed strategy. That if you're waiting for another 2008, you're going to get wiped out, just in a different way.
This is where the whole thing pivots. We have to stop thinking deflation and start thinking inflation, an inflationary crash.
Which the source calls the reverse market crash. It's where asset prices, especially the scarce ones, seem to be skyrocketing.
But not because of some huge productivity boom.
No, it's because of the measuring stick itself. The dollar is losing its purchasing power fast. Inflation is just the symptom of that collapse.
And this isn't just a theory, is it? The source claims they saw this shift coming way back in late 2022.
They did. They broke from the mainstream view and then published a really specific call for this reverse market crash scenario in December of 2023.
What's compelling is the data they use to, validate that call.
Right. What's fascinating is looking at how the market actually performed since that prediction. So from December 2023 through October 2025.
It really seems to confirm that capital flight was already happening.
Let's run the numbers. They're pretty stark.
Go for it.
Okay, so the assets that represent scarcity just surged. Bitcoin was up a phenomenal 186%. Gold, the old school hard asset, climbed almost 95%.
And even the big indexes.
Even the big ones. The Nasdaq was up 52%, and the S&P was up 46%.
But that's not the whole story, is it? You have to contrast that with the rest of the market.
Exactly. The Russell 2000, which is more like your small-cap, domestic-focused companies, it lagged a lot. It was only up barely 30%.
So that divergence is the whole insight. It wasn't a broad market recovery. It was a strategic flow of capital.
It was capital flowing into specific inflation-resistant assets.
The thesis wasn't just theoretical then. It was predictive. And the source actually quantified this, didn't they? They compared a portfolio based on this idea against a safe one.
They did. They took a simple, equal-weighted portfolio of those top four, Bitcoin, gold, NASDAQ, and the S&P, and put it up against something like Ray Dalio's all-weather strategy.
Which is supposed to be safe because it leans heavily on bonds and cash.
Right. And the difference is just striking. A hypothetical $100,000 portfolio, using the reverse crash thesis, it would have grown to nearly $194,000.
Almost doubled. And the conventional one.
The all-weather portfolio would have only grown to about $118,000 in that same period.
So it's a $76,000 difference, a 64% outperformance.
In less than 2 years. The takeaway isn't just that a few assets did well, it's that trusting the old playbook, the one where bonds and cash are your safety net, meant leaving a huge amount of wealth on the table.
It meant you were losing purchasing power without even realizing it.
Exactly. The people who saw this shift coming were building wealth, while everyone else was, well, clinging to conventional wisdom.
Which leads us to the big question. If capital is fleeing cash and bonds, where is the real bubble?
If it's not housing, and it's not the overall stock market like we're always warned.
Where is it? The source says it's hiding in plain sight.
Right in the foundation of the entire global financial system. The real bubble is government bonds and the dollar itself.
Okay, but hang on. We've been hearing warnings about government debt for, like, decades. What makes this different? Why now?
It's the scale, the sheer unmanageable scale of it, combined with the fact that the market mechanics are just broken.
What do you mean by that?
The U.S. government is borrowing over $2 trillion a year now just to stay afloat. That's an unprecedented level of debt outside of, a major war.
And who's buying all this debt? It used to be foreign governments, right? China, Japan.
It used to be, but they've been stepping away. They're not the reliable buyers they once were.
So, who's left?
The domestic market. That means primarily the Federal Reserve printing money to buy it and passive flows from banks and funds that are forced by regulation to hold it.
So the market stability is artificial.
Completely. Its safety is based on the hope that the central bank will just keep absorbing the supply forever.
This connects directly to a quote from Air McCann research that the source cited.
Yes. They said, the current bubble is not like 2008, which was a credit bubble. It's a currency and treasury bond bubble.
A credit bubble is a crisis of solvency. A currency bubble is a crisis of value.
And that's the key distinction. When the foundation itself, the very measurement of value, is unstable, then everything built on top of it gets shaky. Your stocks, pensions, real estate, it's all resting on a foundation that has to be constantly devalued just to hold itself up.
Okay, so if capital's really fleeing the dollar, we should be able to see the symptoms of that, right? In the market's behavior.
And the source argues that these clues are everywhere. They make seemingly irrational market moves look, well, entirely rational.
And the first clue is the dominance of big tech. The Megay 7.
NVIDIA, Meta, Amazon, Apple, Microsoft, Tesla, Alphabet. As of mid-2025, these 7 companies made up about a third of the entire S&P 500's market cap.
A third? That's insane. And their returns are basically driving the whole market.
In 2024, they were responsible for more than half of the S&P 500's total gain. You had NVIDIA up 171%, Meta up 85%.
And the argument is these aren't just bubbles in those specific stocks.
No, they're acting as pseudo-safe havens. Capital is fleeing cash, and it's rushing into these high-quality, dominant businesses.
By them specifically.
Because they have global revenue, incredible pricing power, and near monopolies. They can survive and even thrive during high inflation better than almost anyone else. They're just a better store of value than a depreciating dollar.
That reframes things, doesn't it? What looks like speculation is actually a defense mechanism.
Yeah.
But what about the really wild stuff, like the NFT market, CryptoPunks? That seems like pure gambling.
It looks like it, I know. But the psychological explanation is compelling.
Which is?
When the currency you use every day feels fundamentally unsafe, when it's constantly being printed into oblivion, people will leap into anything that gives some sense of scarcity and value outside of fiat.
So they're just desperately searching for something that can't be printed.
An unprintable store of wealth, whether it's digital art or a hard asset.
And then, of course, you have the main evidence. The outperformance of Bitcoin and gold.
That's the constant confirmation. The fact that these digital and metallic safe havens have just crushed most traditional assets proves the currency flight thesis.
The source mentioned on-chain Bitcoin flows, too.
Right, showing that sophisticated investors are moving capital into their own custody off exchanges. They see through the illusion that cash is safe and are preparing for a world where they need self-custody.
So to put it all together, what looks like a tech mania or a crypto bubble
Mm.
is actually just a series of rational safe haven bids from people trying to protect their purchasing power from a crumbling currency.
And this brings us to maybe the most critical point for you, the listener, why this reverse crash scenario is actually much worse than 2008 for the average person.
Yeah, 2008 was awful, but there was that reset. A new generation got a chance to buy homes, to buy stocks.
There was an opportunity. It was a painful, but in some ways, economically healthy reset.
The danger here, though, is that when money itself is the bubble,
There's no reset button. There's no chance to get in later.
and the consequences of that are devastating for anyone just trying to save. If you're holding cash, waiting for prices to come down.
They won't. They'll just keep running away from your debasing currency.
So housing becomes permanently out of reach.
Your savings get inflated into nothing. Retirees on fixed incomes are absolutely crushed. And the middle class just gets hollowed out as their buying power evaporates.
So the harsh reality, according to this analysis, is that unlike 2008, this time there's no second chance unless you are correctly positioned before the system breaks.
It forces you to rethink your entire strategy right now.
Okay, so what is the path forward? The source says the winners will be the ones who front-run the collapse.
By owning scarce assets that can't be printed away.
And the specific recommendations are pretty clear.
They are Bitcoin for its absolute digital scarcity, gold as the oldest form of hard money.
And then prime real estate and actual businesses.
Right, businesses with real cash flow that can raise their prices along with inflation.
And the losers are just as clearly defined.
Anyone sitting in cash, anyone hiding in government bonds thinking they're safe, or anyone in diversified assets that just can't keep up with the rate of monetary debasement.
It sounds incredibly daunting, but the source frames it as a once-in-a-generation chance to multiply your wealth.
For those who see it coming, yes. While everyone else gets blindsided by rising prices instead of falling ones.
So to sum this all up, we've done a deep dive into this thesis that the financial crisis is shifting from a deflationary asset collapse to an inflationary currency collapse.
And that makes the dollar and government bonds the real bubble to watch and the biggest risk to your savings.
You know, this whole analysis, it forces you to completely reevaluate how you think about risk and volatility, which brings up an interesting final question.
If even the safe assets aren't safe, how do we correctly interpret what we're seeing in the markets?
Right.
The source points to a historical chart from the Weimar Republic's hyperinflation. On that chart, gold looks incredibly volatile when priced in the local currency.
But the real story wasn't that gold was risky.
No. The story was that the measuring stick, the currency, was collapsing underneath it. And that powerful image makes you wonder, doesn't it?
It does.
What market volatility are we seeing today that we're misinterpreting as asset risks, when the real hidden risk is just the declining value of the dollar itself? That's definitely something to mull over.
Thank you for joining us for this deep dive into the reverse market crash thesis.
Thank you for listening to today's episode. And don't forget to like, subscribe, and share your ideas for future episodes. See you next time.